If there was one lesson you could teach every new investor, what would it be?
Start, invest regularly, stay the course, and be diversified. They're probably the four, right? If you stay the course with the wrong stock, you're going to get smashed. So you kind of I'm assuming you're investing in a decent portfolio. The young Scott Phillips did something really stupid. The young Scott Phillips got a promotion at work, and back in the day, you used to get a car allowance if you had a certain level of seniority at a company, right? It's all wrapped up now in your package. Car allowance. So you can take the money as cash, or you can lease a car. And I went, well, I'm getting extra money. It's free money. I might lease a car. And so I leased a $64,000 Volkswagen Passat. I was a value guy. I wasn't going to go the Audi or the BMW. That's wanky and expensive. I'm going to go the Passat because it's a solid European car. Really, it was a lovely car. I loved driving it. But cheaper than the other stuff. So it's a smart idea, right? When I look at the value of, and this is me being the boring finance nerd, when I look at the compound value of what I spent on that car, what I got for it, had I invested that instead, I probably cost myself a 7-figure retirement, right? That's literally what compounding does. And I use that example, firstly, to say I'm an idiot. Secondly, the value of if you can start young, you can lag the market by a couple of percentage points a year and still retire a millionaire, right? You don't have to be very good. In fact, people say, oh, you're young, you can take more risk. I would say exactly the reverse. You're young. Why the hell would you take the risk? You can just let compounding do the work for you and retire really wealthy. If you can save regularly, invest it half decently, even reasonably ordinarily, you can lose to the average and still do really, really, really well. Now, don't lose to the average, buy an ETF or beat the market, but they're your opportunities, right? So I really want to tell people, yes, by the way, investing shouldn't be exciting. Again, next Afterpay, right? That's our marketing. Once we get you inside the door, we say, thanks for coming. We'll try and find you next Afterpay. By the way, this is not about hitting refresh on your computer. This is not about making 100% returns in 6 months' time. This is not about the ups and downs and the dopamine and the excitement. If you want excitement, go to the racetrack. Investing should be slow and boring. ASOP, the more I learn about investing, guys, I've mentioned ASOP's Hare and Tortoise way too many times in the last 12 months because whenever I come back to it, it's literally just that. We know, we were told thousands of years ago. How do you invest? Well, be the tortoise. Just be the tortoise. And compounding is so magical. It does the work for you. Get started. Invest regularly, stay the course, be diversified. 99% of people who do that will be extraordinarily stoked on retirement with how much money they've amassed.
I had a lot of bad behavior as an investor. And, even after this dot-com crash and my kind of switch into, okay, I'll focus more on dividends, I traded too much. I just turned over my portfolio too much. And I think, I didn't have, I had a little bit of money. I was in uni. I wasn't working. There was no money coming in. So every time I came up with this idea, I had to sell something. And, I think that was just really, really poor behavior from, I wasn't making any money. So frankly, the tax outcomes were not that bad at the time. But it was just this really poor behavior that held me back. And, I can sit there as a 45-year-old and think, wow, if I would have just bought some solid names, I still own a couple things from that era, but if I would have just bought some solid names, stayed in them, I would be in a much better position today. I can't get that time back. So I think it's just focusing on behavior and what are these mistakes that hold us back. And yeah, people always say, it's a cliche, think about your future self. But yeah, I wish I had that opportunity. I wish I could go back and even without knowing where share prices went, just go back and kind of relive a couple of those years and just not waste all this money on transactions and taxes and everything else.
Block out the noise. It's really simple. Still happens today. Okay, you have to understand that there are whole newspapers and television channels that are dedicated to get your attention about what's happening in financial markets, okay? And so they spend their entire time trying to explain what's happening based on, it's risk on, or, people are worried about rates or growth slowing. And they'll always go back to the economy. They'll always go back to the economy because that's the one thing that they can constantly fill news with. Does that make sense? So they'll try and convince you that the equity market and the economy are the same things, okay? They're not. The equity market is not the economy. The equity market is not the economy. I'll say it over and over again, okay? The stocks that you're investing in are generally being driven by a large structural change or their competitive position. That's what really matters over a 5 to 10 year view. And all that other stuff is noise. And the whole industry is designed to push it down your throat. And the quicker you block it out, the better you will become as an investor.
Except for podcasts. Podcasts, not like the rest.
100%. Podcasts, not 100%. But to you guys' credit, I'm pretty sure you're not doing podcasts on the macro all day.
No.
So that's not noise. That's
Yeah.
learnings.
Yeah,
That's
yeah,
learnings.
yeah,
And look,
yeah.
I listen to podcasts too, particularly if I want to learn about a subject.
Yeah.
But yeah, if you're just listening to a podcast if you're stuck listening to what central banks are apparently going to do, that's not a good use of your time.
One must be patient. Some of the great gains that are made in stock investing is not, I doubled my money, how good am I, and moving right along. It's staying the course. It is not folding. It's staying with winning positions and letting them run. You must be patient. Otherwise, how do you get a 10 bagger? How do you make 10 times your money on a stock you love and you believe in? You need to resist the temptation to take the profit, which in some cases, some investors' minds should be just not looking every day at the price. That's the magic of your theoretical 30-year portfolio. It will look after itself. It'll compound up. So I think in matters of finance, one must be patient. That belief was born out in reminiscences of a stock operator. If anyone on the podcast has not heard of it or is curious about it, I suggest that you do buy it. And one of the key tenets in that book is the big money in stock investing is not made in the thinking, it's made in the sitting. And that is, there's no truer word has been uttered in the context of share market investing. It's the sitting that makes you the money, not the thinking. So that would be my most ardent advice for investors.
I love that.
Understand what you're investing in, and be really clear on why you own the stock and what it's worth. Something that you hear sometimes, and I think I don't know that I agree with that, is volatility equals risk. I mean, I don't really think that's true. I think, risk is the permanent loss of capital. Volatility, that's just part and parcel of equity markets, and that creates opportunity. Volatility, that's, a stock goes down, that could be your opportunity to buy a great business at attractive valuations.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.